The basics of personal finance are very simple. And that's why when you have your finances in check, right, and somebody doesn't, it pains you so much because you know how easy it can be.
Explain ETFs. Why are they safer?
Okay, so let me put it like this. The way that I'm going to invest as a 26-year-old is different to how somebody who is in their 50s is going to invest. Because if you are nearing retirement, you cannot risk your money like that. But if I'm 27, I have how many years now?
Welcome to another edition of Mindset Profits, and we're back to talking finance and investments. Today, I'm talking to a young lady who comes highly recommended by one of the followers of the channel, and she talks a lot and quite passionately about investing, starting early. And her name, Lerato. Welcome to the podcast. I want you to introduce yourself the way you give your bio.
Oh, okay. I am Lerato Mochaki, born and raised in Polokwane, Muleji, right? Let me not round it off to a town. I'm in a small village called Muleji. Yeah, I'm very passionate about personal finance. I have a degree in accounting sciences. So I would say there's a link there, right? Don't know if I should say finance is my thing, but yeah, that's how I would...
That's way too simple for the good work that you're doing out there.
Am I really done playing what I'm doing?
You are.
Is that what you're saying?
Everyone watching this episode is going to find out what I mean, because I've checked your content. It's quite educational. You're doing good work. Why did you decide to get started, actually?
With what content?
Pushing content on financial education.
I think it's just passion, honestly. When I started talking about this, I never thought that, well, one day I could have a YouTube channel, you know. I was just way too passionate, and I would talk about this on WhatsApp status. And then, well, TikTok came along, and I was like, okay, maybe I need to like share something. Like I just had that burning desire to share. At the time, I was sharing how I saved more than 10,000 as an intern, earning 8K, right? I just thought, okay, like somebody might need to hear this. And I somehow just felt good about myself, given what personal finance is about and what we are trying to reach. I just thought, okay, let me share this. And I got to realize that a lot of people actually love this kind of, I would say, feedback in a way. Like the outcome, you come and say, oh, this is how much I was getting, and this is how much I was able to save and invest. And yeah, it just took on from there. But for the longest time, I was on TikTok, and then I decided, like probably 6 months or a year later, to go to YouTube.
And Facebook.
Yeah, and Facebook. Facebook came a bit later. I think 6 months after I started my YouTube, because I was not on social media. I didn't have a Facebook account. So, but I just thought, like, once I started with YouTube, I realized that, okay, I need to have a community.
Okay,
yeah.
Beautiful. I think one impressive thing that I've seen is you are actively investing.
Yes.
And you are teaching people about investing and showing them some of the evidence from your results investing. Yes. What do you think stops people from investing, especially young people? Because what I want us to talk about today is some of the mindset shifts you need to make so you can start investing, whether you are young or an entrepreneur, because I know entrepreneurs, most of you are not investing at all. You believe business is the only investment that's worth it for you. But what have you seen stopping people from investing?
Firstly, the education. That's where it all starts, right? You need to get the education. And I think because it can be so overwhelming, it can be a lot. You don't know where to start. The thing that people know and are exposed to is save your money, save for rainy days. So when you come and say, oh, but there is stock market investing, and then you also share the risks associated with stock market investing, and given the fact that we are so emotionally attached to our money, then people quickly be like, hey, no, I can't do that, right? I would say we then need to shift from being emotionally attached to our money, because you get to miss out on potential gains.
Tell me a story of someone who was emotionally attached that you came across.
Okay, so saving is something that people are very much comfortable with, right? It's difficult to convince someone. I realized that it's difficult to convince someone to do something about their money if they do not go out there and get the basic education themselves, right? And now talking about the attachment that people have. If I come to you and say, you can actually get way ahead with investing, when they think of the possibility of losing their money, like no matter how much you try to show someone, if they do not keep an open mind, it's going to be difficult. And I do have a first-hand experience, right, on this, where the person had their finances were a complete mess, right? I do mentorships. I don't know if you know that.
Yeah.
The person's finances were a complete mess, like 100% messy, right? They had a lot of bad debt, obviously, and to kind of give somebody a map, right, to say this is where you can start. If they never saw themselves getting out of that bubble, it's going to be difficult. If they were never exposed to anyone closely, investing, saving, you're telling them a foreign thing. It's difficult for them to understand and even believe you in a way. So that is the difficult thing, trying to convince someone. That is why I don't believe in convincing anyone, right? That is why I just put out such content, and I'm saying, if this lands to somebody who needs it, and over time they can move from being in their bubble and actually understand that they can shift their mindset and understand that if now they start investing, saving, then they can actually get way ahead.
Looking at this person that was drowning in debt, did they come out?
Yes, they did. But now here's the thing,
Yeah.
right? They were able to come out for as long as we were in contact. Don't laugh about
That sounds
it.
like I need you forever.
You get my point. That is the thing. And it's like it's the very same thing. When if we spend most of our time together, we're going to end up doing the same things, right? And obviously if you're doing the right thing, I'm going to gravitate towards that. But if I do not see the importance of doing the right thing, the minute I lose sight of you, it's done. Right? The person is going to go back to their old habits. It's similar to addiction issue. You can take the person to rehab, but if they do not see themselves actually freeing from that addiction, it's a difficult thing.
All right. Before they backslid, while they were still with you,
Yeah.
what changes did they make for them to get out of debt? Because this is something many people are struggling with.
The first thing was budgeting.
Is it?
Yeah.
Sounds so simple.
I think personal finance is simple. I think the principles are very universal and simple. The basics of personal finance are very simple. And that's why when you have your finances in check, right, and somebody doesn't, it pains you so much because you know how easy it can be. So I would say budgeting, that's where it starts. Because
what did the budget look like for someone like that who's in debt? What do I put in my budget?
Well, you're going to have the first line as your income, followed by how much you're going to pay in your debts. That's how it, because that is your priority at the time. You don't have to
with this person, you were not talking savings and investments. It was, let's fight this debt first.
Yeah. It was that. Because, well, obviously, given the size of the debt that they have, I actually got to realize that if you dedicate this much, if you deprive yourself for 6 months, you're going to be good. And also, savings are very much important. We cannot excuse that, right? But a big chunk of their, I would say 20%, if talking about budgeting rules now, was going to their debt.
Also, they committed 20% to paying debt. That's actually impressive. When you were looking at their personal budget on how they were spending before, did you identify line items of what to cut?
The thing is, Nintendo, there was no budget. There was no budget. That is the thing.
How did you identify what sacrifices they needed to make?
No, before we come up with the plan to say this is what you're going to do, they did not have a budget. And it's through conversations where you get to realize that, oh, actually, you did not have a budget at all. Like, you were just going, right?
Yeah.
And then now we have to implement a budget, because if you are going to be good with your money, we need to have systems in place. I believe in systems. You need to have the systems in place. Yeah.
Okay. If I were to say, for someone like that and other people that you've seen, how do people find themselves in debt?
It's a lot of factors, hey? Yeah. No, this
Some
is
of
a
the
big
top
one.
ones that come to mind. As a coach, you've experienced this.
You know, being young, right? Being young, graduating, you just graduated, and like this might sound sensitive, like what I'm going to mention, right? We struggle with inferiority complex in the Black community.
Okay.
That the minute you start working, you want to prove to anyone that, oh, you are able to, right? That, I would say, is a big one. Is a big one.
Flexing.
Yeah. Flexing and flashing and showing people that, yeah, you know, like I'm back in the village, listen, I'm this and that. You know, I would say that, and I would say, just trying to keep up with the people that are around you or you see on the media. Like, we're exposed to a whole lot of things. And if at a young age you are not able to manage that, which is a very difficult thing to do, then you're going to find yourself in debt.
Okay. So I told some young guys that in a community that I coach that you're coming.
Okay.
And I wanted some questions that they have. They're all
right.
young.
Yeah.
They haven't
I'm
started.
also young. Yeah.
It's good because they get to benefit from listening to a young coach.
Yeah.
They haven't started with investing. So I've got a couple of their questions here. Then the big one was, I'm afraid I'll lose my money if I start investing. Be it your shares and stocks, bonds, whatever. What if I lose my money? I want to hear. They said, ask her this.
Okay.
Investing is risky. I might lose my money.
Okay.
That's why I will not start.
So
even if I'm young.
Right. So let me put it like this, right? If you are not saving your money, let's say they're not saving, right? This is just the money that they have on them.
Yeah.
They can lose it either way and without any potential gain. But if they put it in the stock market, they can lose it, let's say at what, 20% chance, and then they can gain even more than that. So if it's about losing money, then let's go with the best worst. let's go with that.
The lesser of the two evils.
Yeah,
So
the better devil, I guess.
You're basically saying it is possible. You can lose your money.
You can lose your money, but listen, I was not here like 30 years ago. I don't know how things were back then, but we now have things like ETFs, right? I'm not saying you are not going to lose your money, but the chances of you losing your money are at a minimum. So
explain ETFs. Why are they safer?
Okay, so let me put it like this. People are mostly, when we talk about the stock market, we're thinking individual companies. ShopRite, Discovery, all of this popular, like the top 40. Right, the top 40. And that's where actually the investing fear comes from. To say, we can see how these individual companies are volatile in the short term or even in the long term, right? But the volatility is very much visible in the short term, where we see like the price going up and down in the short term. And the person might say that, okay, I don't know if I'm comfortable with risking my money looking at the fact that the graph is not linear, like your money is not growing linear. And this is what people want, for their money to go from 0 to 100, like no curves, right? You get to, that is very much obvious with individual companies. And then we have ETFs, where it's a fund with a lot of companies
pulled together.
Let's say it's 4 of us in here, and somebody comes in, they say they want to beat us up. We're going to show them flames because we are 4. It's 4 versus 1, right? So when in an ETF, you are actually having a lot of companies that are fighting for the fund, that are fighting for your investments, fighting for your money. So it's very unlikely that you're going to lose your money in an ETF as compared to an individual company, because an individual company basically saying, I'm taking all of my money and I'm putting it into this company, and this company must make me money.
And you're saying because it's pulling many companies together, some can do well, even if 1 or 2 does badly, it gets offset by the gains of the other.
Yes, and then your performance is actually being averaged out. You don't even get to see that, because Shoprite was not having a good year, it went down. You don't get to see that effect because you have other 100 or 500 or even 3,000 companies that are carrying the fund.
Okay.
Yes.
All right, so ETFs are a better and available option. The second question was, it's more a comment. I prefer Forex. It grows faster.
Yeah, fast money. Who doesn't want fast money, right? But it goes, it all boils down to risk appetite, right? A lot of men have a high risk appetite. That's why most of you guys go into Forex, because you have that bone in you to keep calm. Like, imagine if I'm just a girl and then I lose my money in Forex. Depression, But if that's what they prefer, I'm not against the idea of trading. Just that it's not what my content is all about, right? It's another way of making money. We always have to look at ways in which somebody can make money. And if you can make money in Forex, then go for Forex. Those are financial markets. They're going to be here, even in the coming 20 years, they're going to be here forever. And if you have the skill of trading Forex and making money through Forex, then 100%. But as a personal finance enthusiast, I would say, let's not forget the basics of having a budget, having an emergency funds, of having savings, because it's risky. I would put investing and trading in the same room when I now look at personal finance basics, right?
Okay.
You cannot start investing or trading without any emergency funds, because if you take your last money, you put in the stock market or into Forex, whatever, if the market takes a knock, you're going to go to debt. You're going to go back to the cycle that most people are trying to get out of. I would say if you see that you can make money faster with Forex, I would say, okay, fine, 100%. But I would actually advise that you take the money and consider investing for long term. Yeah, for long term, to just preserve your money also.
Is there a percentage that you suggest for people to say you can devote this percentage to more riskier investments? For someone like that, who's going to do Forex anyway, to say maybe of the 100% that you have to invest, put 80 in something safe like the ETF that you suggested, or the bonds, and use the 20% so that you don't cry if it doesn't work out.
Yeah, I would actually suggest that, because you're going to lose your money. I think Forex is the most riskiest, right? I'm not exposed to people that trade Forex, but just observing how other people talk about it and go about it, you actually get to see that most people lose money with Forex. I would say split the money, save some of it, or invest some of it in ETFs, because they're safe, right? And then push the other half, or the 80% or the 20% with Forex, and then take that money and look to go into other investments.
Okay.
Yeah.
How do I kill the fear of losing money and just getting started? Because I think it partially comes from, I don't know if I will start and do the right things. Maybe I'll start and invest in the wrong assets, wrong shares, and just choose the wrong things.
I would say, if you don't have the answers, right, just be okay with the possibility of you losing your money. I know it's difficult, but be okay with it. And then go to find the safest investments that you can go into. And we are talking about ETFs, right? I would say then look to invest in diversified ETFs. ETFs on their own, we know them for being diversified, right? But now we do have ETFs I think it's FINI 15. This is on the financial sector in South Africa. That ETF is not diversified because it's in one sector, right? It is not diversified. So you cannot go into that kind of an ETF. Go for the likes of the MSCI World. It's different countries. It tracks companies across different countries, different sectors. So go for those kind of ETFs that are well diversified, that you are not putting your money into one industry, then that is
so you can
safer.
diversify industries and sectors, and you can diversify countries in the ETFs that you choose.
Yeah. And that's why sometimes I just feel like diversification, some people do not understand, right? Like how deep it can be. And people just think that simply because you invest in ETFs, then you are diversified. If you put your money in the FINI 15, you are not diversified.
Okay.
Yeah.
What's a good percentage growth rate on average that would attract you to invest in an ETF or any share?
I would say,
what's an average growth rate to expect so that I know I'm on the right track?
I would say look for an ETF that can give you a return of 15% a year, right? And there are a few
50% is good.
15.
1.5.
Yeah, 1.5.
Yeah, I'm saying that's good.
Yes. There are a couple of ETFs that if the economy is good, they can give you at least that or even more, right? And I'm talking about your S&P 500, the most popular one. This ETF, when I checked its performance, like probably 4 months ago, the 1 year movement share price was at 20% and even more.
Whoa.
Yes. Just not now.
Those are some good numbers.
Yes. So, and you actually find this with well-diversified ETFs. Yeah.
Because now I know those are good numbers, because if you put in a calculator what that can do for you in 10 years, 20 years, you'll be shocked at how much you make with 15%. Actually, at how much you make with 10%. If I look at that, though, still comes back to the Forex guys, because they'll look at the 15% and say, 15%, that's per year.
Yeah.
Now I get that per day.
Yes. That's the thing with trading. You make a lot of money in the short term.
Yeah.
Yeah, you make a lot of money in the short term. And
have you tried it?
No, I haven't.
Oh, you?
It's too risky for me. I don't know if I'm just being a girl, but it's just too risky for me. But also I do understand that nobody wants to lose their money. So I cannot go into Forex without knowing how to go about it. That is me gambling. Like anything that you take your money, put into without understanding, you're gambling with your money.
And you stay away from that.
Yes. And even with stock market investing, people gamble with their monies.
Okay.
Yeah.
The other question that I thought, when I saw this, I thought this one was interesting. How do I get started if I'm on a very low budget? And the follow-up to it was, is it through easy equities? So this is someone who is very low budget, probably starting up. How do they get started? What are the minimums that you can get started with to start investing? And is easy equity their option for starting if they're on a low salary and getting started?
Yeah, I would say easy equities 100%, right? And that is because I've always been on easy equities. But then I do know that it is one of the platforms that have the lowest fees. And it didn't have a fee, remember, before, a year ago. And they charge you a fee of, I think, 25 rands, right? That is
per
month. But then also, you can get to be exempt from that if you invest consistently, like you deposit money and invest consistently. Even if you put in 100 rands, you're going to be exempt from that 25 rands, right? So I would say look for easy equities. And if there's any other platform, right, I'm not trying to push easy equities, I'm just talking about what I am exposed to. If there is any other platform that they can start investing on that has low cost or no cost at all, then they need to look into that, right? Go for the lowest cost investment platform, and then because you are starting out, you want to first start by building the confidence. It can be easy for you and I to say, oh, but just go 100% go all in. But for somebody who is starting out, they were never exposed to this. They don't have that much of experience in the market. So you're telling them something is like too good to be true, right? So I would say start small. If you can start with 500 rands, put it in and put it into well-diversified ETFs. And in 6 months, you're going to be in a whole different position because you are now actively investing, and this is going to spark your interest that you go out there and seek more information. Like, when you're interested in something, you just wouldn't mind sitting down and listening to Mindset Profits podcast of somebody talking about investment because you now understand. Yeah. So I would say do that and get the basics of investing. That is going to set you up. And once you understand the basics, the principles, then you are gone. Like, you wouldn't even mind putting 5,000 into the stock market because you now understand what you're doing and what you're getting yourself into, and understanding the potential gains, because that is going to keep you going. Understanding that this is how much you can get. This is how you're going to benefit in the coming 10 years or 50 years.
Okay. When you say the basics of investing, what do you mean?
I would say understand the stock market, right? Understand why those companies are there and what they're trying to achieve, right, by being listed on there. And when you understand the fact that when you start investing, you're actually giving a company money, you must have an expectation. That's where it starts. You must have an expectation. And when I talk about expectation, we now have to talk about investing strategies. The biggest mistake that people make is to invest for the sake of investing because people say you must invest. But what is your expectation? Then we're now going to talk about growth strategy and dividend investing strategy. Are you expecting capital gains or are you expecting dividends? That is going to give you an investing strategy to structure your portfolio to say, I actually want my portfolio to be 50% into growth, 50% into dividend investing.
Explain the difference between the two. Growth and dividend. So, I know you speak a lot about investing for dividend.
Okay.
But just differentiate the two.
The two, right? So, with growth, you're actually saying, I am betting on this company to flip my 100 rands and make it 200 in the coming 5 years. Right? That is growth in your investment. And then with dividends, you're actually saying, I'm going to give you 100 rands, and I'm looking that in every 6 months, like within every 6 months, you're going to pay me 10 rands dividends. So I'm into dividend investing for passive income. I give you my money and you promise me to give me maybe an 8% dividend yield every 6 months. With dividends, you're looking for income, consistent, sustainable. And then with growth, you're saying, you know what? I'm not going to need this money anytime soon. I don't care about dividends. I'm just looking at the fact that maybe in 5 years when I come and check my shares, I would have doubled my money. That is growth. You're growing your money. With dividends, you're saying, I'm giving you my money. You're giving me an income.
On a platform like Easy Equities, how do I differentiate? How do I know that this one is growth, this one is dividend?
Well, you have to go and do your research now, right? Because you have to go and do your research, which is pretty easy, actually. Yeah. Because a growth company is not focused on paying you dividends, right? They might not even pay you dividends. Or if they do, they pay you like 1% dividend yield, right? They're just saying, oh yeah, but here's 1 cent. Thank you for the 1,000 that you gave us, right? That company is focused on growth. And when you look at their plans, they're actually taking their profits and they reinvest back into the business. So what happens is when these companies make profits, they make a decision to either take the money and grow the business or take the money and make Ntando and Lerato happy with dividends. A growth company is saying, guys, thank you for your money, but I don't care that much. I'm going to grow my company. A dividend investing company, focused company saying, I want to keep you guys here, right? I'm going to give you dividends. I'm going to take a big chunk of my profits and give you dividends. Growth company saying, well, I'm not going to give you that much. I want to grow my company. So I would say, first look at the dividend yield. That is going to tell you a lot before you even go into further research as to what this company's plans are. Go there, check the dividend yield. If the dividend yield is 10%, you can't expect capital gains. You can't expect growth because they're taking a big chunk of their profits already, making you happy. They don't have a lot to keep to themselves. And then a growth company where the dividend yield is 3%, then my expectation
3% or less.
Yes, or less. My expectation there is capital gains. Because like I've said that you need to go into the stock market with an expectation as an investor to say, am I going to get capital gains or dividends? If you want capital gains, then look for the lowest dividend yield. You also get to see with the share price movement, right? If you go look at the dividend paying companies, you hardly find one where the share price movement in the past year is up by 50%. You hardly get that. You only get that with the likes of Tesla, right? The likes of, in South Africa, we have, I would say, Capitec. Okay. That's a growth company because the dividend yield of Capitec is 1.77%. You're getting paid peanuts in dividends.
Yeah.
Then what is the other thing that you're going to expect? So it's a growth stock. It's a growth stock. Then that is your expectation when you're now going to invest in Capitec.
And if you are then advising back to this person, 500 Rand, is it a minimum that you can start with?
It depends on how much they're willing to lose or how much they afford to invest.
So if they have 100 Rand, they can start with 100 Rand?
Yes, even 50 Rands.
Is it?
Yeah.
All right. So let's say they're starting with 500 Rands and they're committing that from this month going forward, I'm going to start investing 500 Rands a month. Yeah. How do they distribute it between the growth and the dividend stocks and the ETFs? How do they mix that up on either equities or whatever platform they choose?
I am big on ETFs, right? So I'm going to talk about ETFs because that's where there is less risk of you losing your money. So if it's 500, I would say let's first consider age, right? There's what we call time horizons in investing, where the way that I'm going to invest as a 26-year-old is different to how somebody who is in their 50s is going to invest. Because if you are nearing retirement, you cannot risk your money like that. But if I'm 27, I have how many years now? 40-something in the stock market to rectify my wrongs, right? If I'm young, I can take up more risks. If you are 50, you can't. Yes. I would say let's look at your age. And then you then decide, is there enough time for me to invest in growth? Given the fact that if this company or this ETF does not get to do good, can I take that money, sell my shares, put it into now a well-performing company or ETF, and then double that income in the coming 10 years? If you have that privilege of having that much time in the market, I would say then go for growth. You can keep maybe dividends at 10%.
Okay.
But then if you are 50, you can't risk your money like that. I would say build a dividend portfolio because in the coming 10 years, you're going to rely on your investments to make your money. And you're going to want something that is going to pay you dividends every month to sustain your life because you won't be having an income.
That is smart. What's your take on the difference between using this stocks approach and ETFs and someone who says, how do I compare this approach to investing in property? Real estate.
Real estate. So my thinking on this one, right, is that real estate gives you exposure to passive income, right? You know that, okay, if I buy this property, then I have 6,000 every month for as long as there's somebody occupying the building, right? And then if that's what you're looking for, that stability, and you want to have something to your name, like a property to your name, then 100% go for property. But also, let's not forget that it is capital intensive. For somebody who is on a contract at work, cannot go into property. So
because it means debt.
Exactly. And what if they don't get another job immediately after the 3 years of their contract, if it's 3 years or a year? You cannot risk your life like that because you're risking to go into debt, right? So that person, I would say, then look to invest in the stock market. We still do have companies that invest in property. We now talk about REITs, real estate investment trust, and then compare that to real estate. You can still build a portfolio of REITs that are going to pay you dividends every month, right? Without you having to now bear the burden of finding a tenant, maintenance, somebody's fighting, hey, GBV, hey, all of those kind of things, right? It's just about it's about that. Right? It's about that. So
Don't
I would
trigger
say,
our viewers.
you know, but as a landlord, like these are the kind of things that you're
I get you.
deal with. So do you have the mental capacity to handle that? If you can't, you can still take the 300,000, put it into a REIT that can pay you 10% per annum. That is what, 30,000. If you divide that by 12, you're kind of like almost making the same amount as somebody who went to invest in real estate, and you don't even have to incur any costs that come with investing in physical property like that. But I would say consider like the capital. Do you have the capital? If you don't, I would say stock market investing. Property is good.
Define REITs for someone who doesn't know it. Because it sounds like quite a good option for someone who wants to invest in property but is afraid to manage the tenants and all the headaches that come along with it.
So, a REIT is a company that invests in property. When you go and you say you're investing in REIT, you're actually indirectly investing in property, because you put your money in a company that invests in property. So, you invest in property. That's how it's simplified.
Through that company.
Yes.
Are the interest rates different?
The what?
The interest that they pay out, rates, are they standard or they're different?
No. So REITs are so cool, right? Because these are stocks. Let's not forget. They're on the stock market. They pay dividends. Even though how they're taxed under the income tax administration, right? But then now, there's a dividend yield. We have a lot of REITs. Some say I'm going to give you 7%. Some say I'm going to give you 12%. So you get to choose the one that you want to go with. If you want the one with the highest dividend yield is going to pay you more, you can go for that. But let's not forget capital gains and growth. You have to be okay with getting that high dividend income without capital gains, right? So the dividend yields differ. You go with the one that you say, okay, I am okay with 7%. I am okay with 12%. You get to choose for yourself. And with REITs, because this is like property investments indirectly, we have to be guaranteed about income. They are regulated by the law to pay at least 70%, if not 60%, of their profits out as dividends. So with REITs, I would say you're good with passive income.
That is good news to someone. I've actually never looked at them. It's a term there that I just always hear. I've always invested passively on my unit trust and stuff, and I know the growth is not as much. So I called you here for personal reasons, selfish reasons.
Okay. You're pushing your own agenda.
So you're giving me an option, something to definitely look into. All right, so in diversifying my portfolio, there is the REITs, there is the ETFs, there is the stocks with these two strategies that you mentioned, growth stock or dividend stock. What about bonds? How do they come into this mixture?
I'm not don't invest in bonds, right? But then what I would say about bonds is they're also the safest. I would say have them in your portfolio if you want to, right? So we do have traded bonds, and then we do have traditional bonds where you have to go and buy on, is it SA retail bonds there, right? They do have high interest rates as compared to a savings account. That is the nice thing about bonds. And the ones on the stock market, I haven't done much research on, but you get the benefit of capital gains. That is the nicest thing, because when the share price goes up, you are benefiting capital gains and you're also benefiting dividends, right? Unlike when it's traditional bonds where you're saying, I'm going to give my 10,000 and you're going to give me this much back as interest income without any capital growth.
So if I'm starting with 500 rands, can I split it across all of these?
Yeah, 100%.
Every month?
Yeah.
100 rand here, 100 here, 100 here?
Yes.
And then observe over the next couple of years, every month, what's happening in each of the portfolios.
Yeah, but we can predict what can happen.
Like?
Right? Because if you are saying it's 500, you're going to put it into bonds, going to put it into REITs, stock, and an ETF, right? With these two, it's a question of dividend paying or growth.
Mm.
You already have two that are heavy on dividends.
Which is the REITs.
The REITs and the bonds.
Mm-hmm.
That is going to weigh your portfolio down. And I was actually having this conversation with someone over a coaching session yesterday, and I said, dividends are nice, but dividends, I cannot classify them to instant gratification because you are happy today. You are happy today, but then when you look at your portfolio performance, it's at 2%, and somebody's floating their 40% capital gains. You're going to feel that jab, trust me. So I would not advise that your portfolio gets to be heavy on dividends. Instead of saying 100, maybe do 50 REITs, 50 bonds, and then 300 between growth focused companies.
All right. So there's another question that I picked up that I had almost forgotten. Can I take a loan and invest?
No.
That was very fast and emphatic. Why?
No, don't do that. Don't do that. Because it takes a long time to get good returns from the stock market. That's why we say investing is for long term. If you take a loan, actually, why would you just do that? Why would you even think of doing that? Right? You are still in the cycle of now being into debt and having to pay back the interest expenses, and that comes at a higher cost. Let's say you took a loan beginning of the year. You took a loan and then you put it into stocks, and then now it's March, and Trump and other people, trade wars, that happens.
Yeah.
You might want to harm yourself. You might want to harm yourself, because then the minute you take a loan and say I'm investing, you are somehow going with the hopes that you're going to make so much money within a short period of time, and you're not going to. Yeah.
That's what happened in 2008. Maybe you're too young to...
Yeah, I was young.
Global credit crunch. A lot of people are using a lot of debt for investment. And then because the banks were collapsing, the system was crashing, the banks called on those loans, and it became so chaotic. Many people were bankrupt.
Yeah. So I wouldn't...
Across the globe.
I really wouldn't advise that you take a loan. I think also just be content with what you have. If you are able to save and invest 200, listen, that's what you have. And that is going to account for a big thing in the coming 40 years. Stick to that, but never risk taking a loan to go into investments, especially stock market investing. Or when if you talk about property, it's very common to finance a property. But with stocks, I would not advise that somebody does that.
Okay.
Yeah.
Have you talked to friends who come together as friends and start this investment journey? Do you think that's something that's beneficial, or it can hurt them?
How? When you say...
Let's say we are 3 friends, we come to you as a coach and say we all want to get started and we're all going to be encouraging each other.
Yeah, that is beneficial. You need a community, right? Because learning this thing and working the journey by yourself, like when you're just beginning, is going to take you a long time. It might take you a long time, unless if you're going to spend day and night consuming so much of personal finance and investing content, you can quickly gain confidence, right? But to have somebody that is besides you, and when your stocks are crashing, they know why. Unlike when you have no idea and then you're going to quickly sell. When you have that community, you have somebody that you can quickly turn to and say, look, what's happening? Because I have no idea why mine is looking like this. And then they can say, oh, no, actually, I read this article and this is what they said. I'll say have that community. But if you can do it by yourself, but it takes a lot.
Okay. Do you have mentors or people that teach you in your journey?
No, I
self-taught all the way.
Yeah, because I started way back. Started varsity. Listen, Nicolette Mashile is that lady. I feel like she crawled so we could run, not even walk. I must give her that, right? So I started 17 when this sparked my interest, right? And at the time I was doing second level. Yeah, 2017. So what I did is I was like, okay, no, but somebody's making money with shares. I don't know what year Nicolette came out to say she made $1 million. That year, that's when I was like, okay, I have to be fully in this thing. That's when I started consuming a lot of personal finance content, investing. And at the time, I'm just a student, but I was just so super interested. And I started reading books. And because I've read a few books, they all made sense because the principles are the same. Storytelling is different. But me, I would say, of course, consuming online content really helped a lot, and reading books. But yeah,
I guess the books land easier if you are watching the content but also doing it practically, so you get to see it in real life.
Yes,
it makes so much sense when you're reading about something that you're doing.
Yeah, and the good thing is Easy Equities has a demo account where you can put that into practice without risking your money. Yes,
something for you to download if you have not already.
Today, actually.
Are you an affiliate?
What do you mean?
Affiliate of Easy Equities?
No.
See, if you were, I would have put your link and said, download the link in the description.
yeah, but that app is amazing, man. We can't dispute that.
I've heard you talk about it so much, I thought you were an affiliate.
No, it's just a platform that I use. Maybe I need to pitch and be like, how, guys?
Okay, you say you read books. Are there some that stand out for you that you'd say, this will teach you about investing?
About personal finance, right? That is how to become your own financial advisor. I think it's Warren Ingram, that one. So firstly, I read How to Make Your First Million because, of course, Nicolette Mashile, right? How to Make Your First Million. And then I later learned that he has another book, and then I bought How to Become Your Own Financial Advisor. So I'd say for somebody who is starting, get that book, because it's going to lay out everything about personal finance. And when you move to other books, it's all going to make sense. You're going to enjoy the other books.
Okay.
Yeah.
In varsity, when you started, did you start with friends or you started all by yourself?
All by myself. Remember, this is something that is quite foreign in our community.
It is.
Yeah, right. And I didn't want to say black community, but let me just say in our community.
It is, we all know.
I don't know about whites, right? I just have to say in our community. But I don't like projecting personally, right? If I find something interesting and I don't have anyone that share the same interest, I'm okay with doing that by myself, because the last thing I want is to have somebody who maybe doesn't even know the stock market is, they're gonna pull me back. Because when I come and say, so did you hear that Capitec? Yeah, they're gonna say scam. So, right? Yeah. So for me, it was just okay. I was just by myself because I didn't know anyone, honestly, that took interest in this kind of things. And of course, I would write WhatsApp statuses, but then nobody was interactive to that extent where I would say, oh no, actually we're kind of on the same page.
Okay.
Yeah.
Love it. What do you teach so people can follow you?
I would say I'm more very, very passionate about investing. I love personal finance. I know what that can do for your life, but my content, I would say, is heavy on stock market investing because I do understand how important it is for us to start investing, especially while we are young. And yeah, I would say that.
That's right. All right. So if you go back to other varsity students, because you already started early in your journey, what are some of the things that young kids at varsity colleges, TVET colleges, what should they know about just money and investment? The mindset shift that helped you get started and started so early. What advice would you have for them?
I would say take care of money while you're still young, right? Because life gets to be challenging. This is me speaking like I'm 40 years, but I'm not. Life can be challenging, and as you grow, like you take in more responsibilities, right? The mistake that you don't want to do is to start off your life with YOLO, and then boom, you wake up one day and your life has made a 360. You have kids, you have a bond to pay, you have a car, you have school fees, you have a partner, you have like all of those things, right? Those are financially draining. So when you start as early as possible to build financial stability, you're going to feel confident that you can weather anything that comes, because you're not going to start your next chapter with anxiety. So I would say, take care of money. No matter how little it is, take care of money. Yeah.
Do you think starting early puts girls at a disadvantage? If you start early, you do well, you make the money, doesn't it get hard to find a partner who qualifies, who's at your level?
No, hey? Because, no, I don't think so.
I've seen many ladies struggle with this question. Let's see how...
No, it's a very tricky one, because I cannot speak for men. And there are different types of men, right? With different confidence levels. And I believe it all boils down to that. And also, what is he doing? Do you understand? The last thing a woman wants is to feel like I am way above this person. And I don't think it's solely about money, but about the moves you make in life, like your intelligence, like your thinking, right? Are we on the same page like that? For me, stability is for me. And this is going to benefit, of course, my partner and my kids. That we're not going to start from scratch, at least like also from my part. And I can get to protect myself and the people that I love with what I have. I don't think it puts women at a disadvantage. I don't think so. Unless if it's men who feel some type of way. But
or the men you chose.
Exactly. Well, you also have a responsibility there to to just make sure that you go with somebody that you are on the same level with. You're never going to have the same amount of money in your bank, right? And life is very long. If you now say you're looking for a partner, you're looking at 60 years with this person, if not more. They can earn more than you today. How that is going to be like in 10 years, nobody knows. Yeah.
As long as you're fitting into each other as well.
Yeah, and not being arrogant. I think the mistake that women make, right, is maybe let's say like young women, that's who I'm exposed to, is that when a person feels like they have tested a bit of financial stability, you know, then gidi bosanyana, you don't have to do that. Honestly, you don't have to feel like your partner is now less of a man simply because you were able to get ahead in your life, like maybe get out of debt, start having savings, you know, I feel like, oh, okay, but no, my brother, you are, you know, you don't have to. I just think, well, it's your responsibility as well to keep on being humble and understand that our pockets will never be the same.
Thank you so much.
Yes. Yes.
Now, I have homework for you. I think if you were paying attention, you should go and download Easy Equities. Is there another platform?
I know there's Brockstock, quite popular. There's also Frank.
Easy Equities, Brockstock, Frank. Choose the one that you like. Get started with whatever minimum budget you heard. You could start with at least 50 rands. Let's start building the habit. Lerato says the common thing is for us not to invest. And if you look around your neighbors, your relatives, you'll realize we are not investing as the Black community. And that's something that I passionately hope we are going to change. So from us over this side, we're going to bring you this content until you start investing and get out of debt.
And follow my YouTube channel.
Is YouTube the only platform? Just give us the links, we'll put them.
Okay, I will do that.
See you in the next episode.